RBI as such. The functions of RBI are threefold, namely, 1. Central banking functions. What is that? Central banking function. Hey, RBI, you yourself is a central bank of the country. So as by being a central bank of the country, what are your functions? They are 1. Note issue. Second one, banker to the government. Third one, it is a banker to the bank. And fourth one, control of credit. Fifth one, control of foreign exchange. Right, then it performs even supervisory functions. What are those supervisory functions? It conducts inspections, right? It has got supervisory functions like as I said, the RBI performs exercise the powers relating to licensing, branch expansion, liquidity management, working, amalgamation, reconstruction. We have seen regarding the banking operations, there is a department of banking operations to RBI. What this banking operation will do? It will give license to open up a new bank. It will give license to open up a new branch. It will give license for it will supervise the process of amalgamation and approve also. It will conduct inspection and what it will be doing? It also gives advice regarding the day-to-day affairs of day-to-day working of each and every bank. It can give. It has got. So exercise the powers relating to the supervisory function of the Reserve Bank of India is in respect of licensing, branch expansion, amalgamation, liquidity, management, reconstruction and liquidation of commercial bank and cooperative bank. You understand? This is what all the banking operations in the country are to be supervised. Their finance policy, their liquidity, their management, their licensing, their branch expansion, their reconstruction, their amalgamation, their entire management, they will be supervised by the RBI. You have to supervise because you are a parent bank. 2. Inspection of commercial bank and cooperative bank, and then promotional functions like rural and industrial finance. Now let us refer to these. As I said, regarding the note issue is concerned, regarding the issue of note is concerned, the RBI will go for note issue on the basis of, at the time of its introduction, RBI, it used to, issue the notes on the basis of proportional reserve ratio. But now we are guided by, as I said earlier, we are guided by minimum reserve ratio, where the foreign exchange, gold and bullion to the value of 515 crores should be there. That is the minimum reserve that we should have, and then having this minimum reserve, you can proceed to print the notes. There was a system earlier to begin with. I can only print the note how much is deposited with me, and I will release only equivalent value, not beyond that. But now it is not there. Out of 515 crores, 115 crores only worth gold and bullion, and 400 crore maybe foreign securities, no worry. Okay, and we are rich as far as the foreign reserve is concerned right now, and it is being managed by the RBI. So note issue we have seen, and regarding banker to the government, it is a banker to the government of India. In what capacity? It manages remittance of government fund from one place to another place. It manages the government. It floats loans. I said government means central government, or it could be state government. It floats the loans in case if the government wants any loans, it can be rendered through RBI. Then it manages the debts, public debts of India. It manages the consolidated fund of India, right? Then it collects money, it pays money on behalf of the government. It arranges the transfer of funds, I said. It makes arrangements to supply foreign exchange to the government of India, and as well as the state government. It maintains currency chests and treasuries and other agencies. It maintains currency chests. RBI maintains the currency chests with the treasuries and other agencies in the places prescribed by the government of India, and keeps the chests supplied with sufficient currency notes and coins to provide currency for transactions of the government and also for remittance facilities to the public. So therefore, at any point of time, currency the supply of currency should not be short. Therefore, currency chest will be maintained by the government at various places. It maintained by the RBI at various places, prescribed by the government of India, and ensure that it will provide currency for all the transactions of the government as and when it is required, and also it remittance facilities to the public as such. And moreover, it grants to the central and state government ways and means of advances. Remember, the central and the state government are in need of money to carry out their various projects, welfare projects for the good of the people as such. They may find at that moment they want to introduce and implement certain projects, but at that time they may not have money. They will have money through collection of various forms of taxes, but right now we can't wait also. You can't expect the government to wait. Therefore it raises the bond. Therefore it needs money, it raises the bond. For example, Narmada Dam in Gujarat, way back in early part of 90, they have issued the bonds. 3,000 will become after 21 years 1,11,000. You understand? 3,500 if you invest in 1991, if you invest 3,500, it will become 1,11,000 in 2010 after 21 years. Look at this, 2010 or 2011. It means the government of Gujarat could collect money from the public for the construction of Narmada Dam. That is a sort of a loan taken from the public. How it raised? Who raised? How it raised? RBI raised. The government could collect money through RBI, and of course, the government was confident that after 21 years we will earn money by various other projects in the form of collection of taxes, fees, etc., etc. Yeah, it did. But government may not be having sufficient money at the one go or at the present go. Therefore, it may ask for advance or loan. RBI will give. The moment government gets revenue, then it will remit it to RBI. This way, RBI will not supply money free of cost to anybody. Remember, okay? If that is done, then our money will have absolutely no value at all, right? So this way, in times of emergencies like war, the Reserve Bank of India advances to the government even extraordinary loan. In times of emergency situations, when the country is facing emergencies, the RBI will even advance long-term loans to meet such contingencies of emergency. Okay. So therefore, what I mean to say that as a banker to the government, it will perform its role in these, and again it will act as a financial agent to the government of India. It will act as a as I said, it maintains the public debt, it maintains the consolidated fund of India. Then then what? It is an agent to the government of India. Reserve Bank of India represents the government of India in IMF, IBRD, etc. International Bank for Rural Development, International Monetary Fund. RBI represents the government of India. Therefore, it's an agent of government of India as well. So, as a financial agent, it acts as the agent of central and state government in the matter of flotation of loans. It sells the treasury bills of the government. Government has got a treasury, and the government hopes that their treasury will be enriched with the taxes, tax collections, various fees, taxes, whatever collection. But right now you don't have. You need money, so it sells. It sells to whom? The treasury bill. Government hopes that their treasury will be enriched within 90 days. That much, this 1,000 crores. But on the very first day, 90 days, on the very first day you need. So government, they will, raise the treasury bill and sell it to commercial bank. When they sell it, see the treasury, when the treasury bill worth rupees 100 crore, they may be selling it at 95 crore. For 3 months, commercial bank, 95 or 90 or whatever it may be. When it is sold, don't you think the RBI has succeeded in finding 90 crores to central government or state government? That's what I am telling you. The government will find the money today itself. A commercial bank could purchase it because it could afford to purchase it because it has got huge liquidity. And no doubt it will get back that money. You understand that? It will get back money. In 90 days time, this treasury bill will be purchased by the government, because government that time will find enough money, and the 100 crores are paid to commercial bank as such. What is your earning, Mr. Commercial Bank? 5 crores. That's what I said. It will, by selling the treasury bills of 90 days maturity, it is able to procure short-term finance for the central government and state government, and it manages the public debt of the government of India. Okay, plus it is an agent of the government of India as financial agent, as financial advisor. As I said, it advises central and state governments on financial and economic matters. It also gives advice to the government on matters of international finance. Through Research and Statistics Department of RBI, it collects information regarding the current credit and financial developments of India, and keeps the government informed about these developments from time to time. Therefore, RBI is not entitled to any remuneration from the Reserve Bank of India or state government for various banking services they render to the governments. RBI is not entitled to any remuneration for any of its functions as a financial agent or financial advisor which they perform to the government, the state government or central government. RBI will not be remunerated for that. Remember, because it is its basic obligation to serve the government, to serve as an economic custodian. Then acting as a banker to the bank, you know that it holds the cash balances of the commercial bank, CRR. It could be 3 to 15%, 3 to 20%. The statutory cash reserve ratio could be minimum 3%, maximum 20%. Within this range, RBI from time to time decides, prescribes, fixes. When it is fixed, then your total time and demand deposits, what the total is there, time and demand deposits of that, whatever RBI fixes from time to time, is it 3%, 3.5%, 4%, 5%, whatever they fix, that much of money should be deposited, maintained with the RBI. So therefore it maintains the cash balance of CRR. Then it's a clearing house, as I said, mutual settlement of obligations, especially check clearing and all. Clearing house. The clearing house will ensure the crediting of the amount of the check very fast. The RBI will be a center where all the banks through their agents will collect their checks in the respective branches and come to that clearing house, settle their mutual entitlements and obligations. Okay, right. It provides cheap remittance facilities to commercial bank. It provides financial accommodation to commercial banks in case of need. Right. There are several other. I mean to say that what a bank, normally a State Bank of India or other commercial bank, what commercial bank will offer to us services, they are offered. Much more than that are offered by RBI to those commercial bank, cooperative banks, etc., etc. Therefore, they are the bankers, bank. Okay. There are plenty of those points available. Then it controls the credit. How it controls the credit? It controls the credit by quantitative and qualitative, weapons. What is the quantitative, credit control? Quantitative credit control and qualitative selective credit control. RBI, Reserve Bank of India, is the supreme controller of credit. Explain. Highest, a final controller of credit. Explain. It may be coming. You have to give the introduction about RBI and a little of their, functions. Then you proceed straight away to, a brief of their functions and proceed straight away to their role as a controller over credit. Control over credit, control of credit. There are two types of control, as I said. One is quantitative credit control. That is through bank rate policy, open market operations. Bank rate policy means repo rate, bank rate, at which rate it buys, at which rate it sells. It only on that the lending rate and deposit rate of the customers, banks are there. All the banks, banking sector in India, their lending rate, their deposit rate are guided by the bank rates, repo rate prescribed from time to time No, RBI will do at its meeting of the board of directors, it will do review, revise if need these repo rates, these bank rate from time to time, keeping in mind the economic, keeping in mind the what is that the currency value, the economic policy, the credit policy, totally keeping in mind the value of Indian currency, not in front of Indians but in front of international currency, taking all into consideration. It will not be rigid, therefore it is very flexible. It will ensure that Indian currency will have a good value. It will ensure that banks will not play with the currency. It will ensure that there will be monopoly, etc., etc. Thereby, it will do. What is that? Bank rate policy. Then, this is what. Second one is open market operations. What is that open market operations? This open market operations means, I will tell you, it's very important. RBI will sell, I will tell you. For example, this is a duster. It is a security of the RBI or, it is a security, government bond, either state or central. Now, it is in the possession of RBI. What RBI will do? Hey, Mr. Commercial Bank, purchase this, sir. Its value is, 500 crore. You purchase this. When RBI says you have to purchase, either it will sell or it will purchase. In other words, you will purchase means I will sell. You will sell means I will purchase. That is there, don't worry. And it has got the highest value moreover because government security. And this can be done in two different ways. One, it can be done for two different reasons, I mean. One, government is in need of money, therefore government security is sold to commercial bank. RBI will do. RBI is a link. Okay. RBI is selling to State Bank of India government security worth 500 crores. SBI will have to purchase because it is being sold by RBI. So that the government of India finds 500 crores of money. One is that. Second one, hey SBI, you have got absolute liquidity and you are playing with that. You are playing with that. It may make you to the position of some monopoly. It may take you to the position of some exploitation, something like that. No, we will not allow. You purchase this. I am selling, you purchase this. When you purchase, what happens? Your total liquidity volume is minimized by 500 crores. Now you find, I had 1000 crores together, but now RBI compelled me to purchase that and I gave 500 crore, credited to RBI account 500 crores as a result. So that's what it will ensure. When there is a higher volume of liquidity with the bank, there are all possibilities of the currency notes. There are all possibilities that money of India may be losing its value or money may be moving anywhere like anything. It should be prevented. It should be regulated. How? When it finds liquidity proportion is huge with a bank or banking sector, then it will think of selling the government securities. In which case, you have no other go but to purchase, Mr. Banks. When the banks purchase, their volume of liquidity is thus contracted. See, expansion is this, contraction is narrowing. So your liquidity volume is narrowed. See, I don't mean to say that it will never come back to you, but it will come back to you. When it should come back to you, it will be decided by RBI. It will be decided by RBI, not by you. Why RBI does it? In order to preserve the value of the money as such, in order to ensure that Indian currency will not lose its value or banks will not exploit with the situation as such. So when it sells, you have to purchase. When it purchases, then it will be good for you. When it purchases, there will be, see, when the RBI sells any government security, there will be contraction of money. When the RBI purchases securities, then for the banks there will be expansion of money. Correct? This is what you will find. When it purchases the security, any of your security, then it will purchase. Purchase means it will pay consideration. Therefore, you will find money. So money liquidity is expanded. When it sells, then you have to pay for it. Then your liquidity volume is contracted. I mean to say. Okay, this is where we find the second function, open market operation. Then variable cash reserve ratio, as I said, CRR. I am telling you right now, as far as a controller of credit, RBI is a controller of credit, and this control over the power of the credit of that of the banks, the RBI exercise the control over the power. Control over the credit of the banks. Bank can lend credit, loans, advances, over the power of those banks. The RBI can exercise the control. What way? Credit control by prescribing from time to time the bank rate, repo rate policy, by open market operations. Open market operations means either by purchasing or by selling the securities. When it is purchasing means your liquidity volume will be expanded. When it is selling means your liquidity volume will be contracted. When it is to be done? See, ultimate objective is that value of the money should not be misused. Value of the money should be sustained. So keeping that in mind, for the economy of the country, for the development, economic growth of the country, this is needed. It knows, RBI knows when I should contain the liquidity of the bank, when I should expand the liquidity of the bank. If I have to contain the liquidity of the bank, then I will sell the security to those commercial banks. Thereby commercial banks' liquidity volume will be contractioned, in other words, narrowed. When I find that there is short of money supply, they need money because there is huge demand that is needed also for the growth of the country. Then in which case RBI will purchase their securities. When RBI purchases the securities, RBI will pay. That time your liquidity gets expanded. Open market operation. This is way. And then variable cash reserve ratio, CRR. It varies from time to time. At what rate? I said the minimum 3, maximum 20. RBI from time to time will ensure that in order to promote public credibility, in order to ensure the customers' confidence in the banking system, and also in order to ensure the control of the RBI over the banks, the CRR is introduced. Cash reserve ratio, that is variable between 3 to 20%. It is the Reserve Bank of India from time to time prescribes, Mr. Banks, your total deposits, time and demand deposits, out of that, see, this percent will have to be created in your account with the RBI. If you have total of time and demand deposits all over India, SBI may have about 2 lakh crores, then 4%, it will not to one bank, not to another bank varies. It is same. So CRR, cash reserve ratio of the banks are maintained with the RBI. RBI prescribes the rates from time to time. According to that rate, when it is prescribed, the banks are bound to follow that, and that particular percentage of their total time and demand deposits are to be deposited with the RBI as such. Then you have got other quantitative weapon, variation of SLR. Again, SLR means, CRR means with the RBI you have to deposit that. But SLR means, see, you have collected various deposits into current account, into savings account, into fixed deposit, RD. Whatever total comes, this much. Out of that, say 3.5% now it is, RBI says. So 3.5% you have to deposit with the RBI in the form of a CRR. And 18.5, it could be 15 to 40%. Which one? The liquidity, statutory liquidity ratio. It can be, let me also tell you, 1 minute. A liquidity ratio, it is, correct. It is between 15% to 40%. 15% to 40%. RBI from time to time it decides. Right now I think it is 18.5% of liquidity should be there with you. And beyond that, should be there with you. Why? They say variable statutory liquidity ratio. Any bank for that matter, be it, any bank, excepting the rural bank, they are not that strictly bound by this. Anyhow, it is to fulfill your regular obligation to your customers. When the customer who deposited the money, when he comes to claim back, if it is FD, or when he comes for withdrawals, if it is a current or SB account, then you can't say no. They are asking their own money. You have to pay. Therefore, I said, it may not happen in the case of all customers, but don't you think when any customer comes, you need to pay? How to pay? Can you say, no, I can't pay now? You can't. Banks are not there for economic inconvenience. Banks are there for their convenience. Economic convenience is concerned, for their growth is concerned. So you must have. That is why the law itself clearly, the RBI itself clearly lays down variable statutory liquidity ratio, SLR. It varies. RBI from time to time, either it may sustain the same percentage. Right now 18.5 is there. It may sustain, or they find that unwantedly, that minimum, that there is no demand for the withdrawals and all. Why we should keep it like 18.5? We will reduce it. Or there are more withdrawals, more demand, but bank finds a short of money. Then RBI will increase the SLR. Why? Hey, you don't keep only, say for example, your total, deposits, time or demand deposit happen to be 1,000 crores. You keep, 185 crores, 18.5%. 185 crores, only that much. But when for that much itself there is no demand for borrowing or withdrawal, then RBI may reduce it. When there is acute, when there is huge demand, but you don't find sufficient liquidity, then RBI will increase. RBI will increase SLR. So RBI will decrease the SLR, or RBI may increase the SLR between 15% to 40%. It depends. When there is huge demand, but the banks finding short of money, then RBI will ensure that, no, don't play mischief. There is demand for the borrowing or withdrawal. But there is demand for the withdrawal of their own money, but you say that you don't have. Therefore, I will increase the statutory liquidity ratio to 20%, 25%. I can do. What is that minimum? 15%. What is that maximum? 40%. Rest. Otherwise, what happens? Sometimes, if there are no regulations like this, then what the banks will do? There are more demand for investment, there are more demand for advances or loans, then they will entirely, whatever money that have come in the form of deposits, they will, they will send it through loans, advances, investments, and when any customer comes for withdrawal, asking for the repayment, you say, no, sorry, this is inconvenience, you cannot. That is the reason why SLR is, about SLR, RBI from time to time, depending upon the situation, either it may keep to the minimum or it may go upwards. It depends. Okay. Then we have got a net liquidity ratio. That is another one aspect as far as net liquidity ratio is concerned. What is that net liquidity? How much of money totally that you need to have to meet your needs, whatever. Okay. Right. Then we have got another one. As far as the controller of credit, RBI is a controller of credit, lender of last resort anta helidilva. Hage, he is a lender of controller of credit. One is quantitative credit control, another one is qualitative or selective credit control. Selective credit control is exercised in several ways. One, RBI from time to time will issue directions to the bank. Two, it will also ensure that it will issue directions for marginal requirement. What is my marginal requirement? See, don't provide credit to only one sector. You diversify the risk. And I don't say that it is a risk. You diversify to all the sectors. Why? If one sector fails, other sectors' profit can save you. That is the one reason. Two, I'm not talking about the failure. I'm talking about you are there. Banks, it's RBI being the custodian of our economy, custodian of the banks, banking structure in India, banks operations in India. RBI should ensure from time to time. It should direct all the bankers. See, I want to find balanced growth of all sectors. And there cannot be any sector which is ignored for want of a credit facility. Okay, so that's what from out of your earnings, Mr. Banker, this percent to industry, that percent to agriculture, this percent to self-employment, that percent likewise. You understand how much you can invest, how much you can lend, how much you can advance, and to what all sectors. I want to see that by your lending or advances, you should ensure that balanced growth of almost all the sectors. Of course, sound principles of banking you should always adhere to while doing so. Okay, then you have got a difference rate of interest. See, when it is for purchase of vehicles, keep interest rates at the higher rate. Lending rate could be more. Personal loan, if it is infrastructural in a development, if it is for the infrastructure, say I want to improve my house, then loan rate, the lending rate could be higher. House construction, lending rate could be somehow medium. But if it is agriculture, lending rate cannot be. If the for agricultural operations, if the lending rate is kept at and higher, then it will discourage. It will discourage the citizens of the country or farmers of the country from carrying on agricultural operations. That's what I said. They don't keep, the RBI will never say that fixed rate of interest for all operations. For agriculture, it is one rate of interest, for industry, one other rate of interest, for vehicle loan, for housing loan, for various, for education loan. Variable, in other words, differential rate of interest. Who prescribes, who fixes? It's RBI. And then we have got restriction on clean advances. Don't give clean advances. What do you mean clean advances? It's all possible. Vijay Mallya, Adani, Mukesh Ambani, they're all bigwigs. And what do? You people coming to our bank seeking loan itself is a grace for us. We are not insisting on a security. Sorry, however big they may be, please. However big they may be, you should not be going for clean advances. And you are guided by those, what is that? Lending, sound principles of lending, you are guided by, you are bound by those lending provisions. Because otherwise, it will be falling someday. Then prior credit authorization scheme. This is regarding if the loan is for an amount of 5 crore, 10 crore, okay. But if a loan is it is needed, I think it is closely associated with the restriction on clean advances. Sometimes RBI's approval is required to grant loan if the loan amount is beyond a particular limit. This is called prior credit authorization scheme. Then next, credit monitoring arrangement. What is that? I am telling you right now that we are now discussing, this question is absolutely important from the examination point of view. What is that? Controller of credit. That is the main function of RBI. RBI is responsible for the birth of banking operations in the country. Therefore, it has to take care of its children. It has to take care of its children means it should ensure that they are working within the lines. No ultra-virus, everything should be intra-virus. Therefore, you can, as far as the granting of a loan power is concerned, you can impose a control. We have seen already quantitative control through bank rate policy, open market operations, variable cash reserve ratio, variable net ratio, variable, what is that called? Statutory liquidity ratio. Now we are discussing about the second form of credit control, namely selective or qualitative or selective credit control, which is through differential rate of interest, issuing of directions, then marginal requirements, regulation of marginal requirements, then restriction on clean advances. I will tell you, not restriction, prohibition of clean advances, and then the prior credit authorization scheme. Then credit monitoring. When the credit is granted, especially in the case of some medium or larger loans, I mean any loan for that matter, medium or larger loans especially, there must be credit monitoring mechanism. If the credit monitoring mechanism is not there, what happens? The loan is given to you for purchase of lands and building machineries, etc. But what you have done? You have done it to discharge the obligations, discharge your debts. What nonsense it is. the banks, I mean, very essential. You have lent for purchase of land, construction of building, machineries, etc. And for what purpose they are applying the money? Your borrowers, they are applying the money to dispose of their, to discharge of their debts. So therefore, sorry, this cannot, if this kind happens, then your loan will never be repaid. Because he doesn't have anything. You under the hope that they will apply for purchase of land, building, etc. and that borrower has applied for discharge of debts, how can he make the repayment? Therefore, the question of repayment is a big issue. Therefore, not only granting the loan, ensure that at the time of granting itself, it is safe of repayment. Ensure that while granting the loan, you should also have a proper mechanism for monitoring the administration of the loan, whether it is being properly utilized. Then we have got moral suasion. What is it? Even sealing on the bank advances could also be ceiling limit on the bank advance. Hey, don't ever grant beyond this amount, like that also. Then moral suasion. What is that moral suasion? RBI being the controller of credit. Moral suasion means it is trying. It is like mother and father or whoever, your relative friend, they are advising you. Don't consume alcohols. It is not good from the point of your health and if you consume alcohol, it will consume your life, and if you are gone, we are suffering. So we are dependent on you, not because you need to we will not because your earning is a boon for us, and from out of your earning we are taken care of, not because of that, but because you are a member of our family, we love you, something like that. You are now not by administration of any punishment or penalty you are forcing, but you are trying to morally reach up to him, correct? You are trying to morally persuade him, keep away from. So likewise, the RBI should go for this kind of approach. Instead of going for punitive methods, it can go for sometimes it can go for moral suasion. Means ethically, by adopting ethical principles, it is trying to persuade the bankers from desist from some kind of activities, as they are not good for your growth of banking as such, right? So that's what I said. These are all. And then the controller of foreign exchange operations. Controller of foreign exchange operations, because this is very important. So RBI, you will be failing in your duty if you are unable to control, if you are unable to sustain the Indian currency value in front of foreign currency, you will be failing. So how is it possible? Ensure that Indian currency value is sustained. One. And how is it possible? Instead of you should promote, Mr. RBI, you should ensure that you are promoting earning a foreign exchange operations and not buying a foreign exchange operation. If you buy foreign exchange if you buy dollar, for example, if you buy, I need dollar. For example, government of India is in need of dollar, because if it is to purchase the crude oil, very, very huge amount is required. But crude oil price increasing, dollar, it has to purchase in dollars. But India is having money, currency, Indian rupee, but they have to cough up about 74 rupees per dollar. Huge loss, Therefore, what you have to do, you should promote, the government of India, the RBI should promote how to earn foreign exchange. Don't buy in exchange. Buying in exchange will lead to liability. Instead, you earn, government of India, you are purchasing crude oil, right? And India is the biggest consumer of crude oils. So what you do? You earn dollars and buying of those. When the government of India, when the RBI is sufficiently rich enough in the foreign exchange reserves, then it will sustain Indian currency value. Because there is no heavy dependence upon the foreign. I don't need to purchase foreign currency as I am earning. You understand? Don't purchase, earn. Don't import, export. So many things are there to tell. Okay. So therefore, you are a controller of foreign exchange operation as well. Supervisory function, as I told you, what all the supervisory functions and the promotional functions. Supervisory functions of the RBI consist in exercise of the power relating to licensing, branch expansion, liquidity, management, working, amalgamation, reconstruction, and liquidation of commercial bank and cooperative bank. You understand? Licensing, branch expansion, liquidity, management, amalgamation, reconstruction, liquidation of commercial bank and cooperative banks. Second one, inspection of commercial banks and cooperative banks, and seek for some information regarding the banking operations of theirs. Okay, and lastly, promotional function. Reserve Bank of India, being the custodian of banking system in India, it also performs threefold function: main central banking function, supervisory function. It has to supervise, as I said. When the bank is bound to monitor the loan administration, even the RBI, which is responsible for banking operations in the country, it should monitor by conducting inspections of those banks, supervision. Then whether banks are able to follow banking laws relating to banking are to be adhered by all the banks, so that failure of banks may not be there. It may be very, very less. If any of the bank or banking institution fails, then it is a threat to our growth of economy. It is a threat to our economy as such. Reserve Bank of India, therefore you perform your parent role as well. Supervise, inspect, etc. What of those banks, banking institutions, any licensing, any branch expansion, everything meticulously you study and then decide. And lastly, promotional function. Promotion of financial institutions in the country, like we have seen Industrial Credit Investment Corporation of India 1983-84. Who has incepted it? RBI. What is the function of RBI? Promotional function. 1. 2. NABARD, National Bank for Agriculture and Rural Development. What is that function? Why NABARD is set up? NABARD is set up to promote the rural credit. And we have seen in the earlier classes, what is that? State Cooperative Bank is a balancing center. Or link between various district cooperative banks. There are 31 state cooperative banks in the country, 525 district cooperative banks in the country. I'm not talking about its branches. I'm talking about the main offices. So it is a balancing center. For example, in Karnataka State Cooperative Bank, or so-called Apex Bank, is a balancing center between various Karnataka district cooperative banks. See, Karnataka's Apex Bank will render financial assistance, will lend to various district cooperative banks, which will in turn lend it to, or which will in turn supply it to primary credit societies or rural credit cooperative bank. So they are made available with the money in case if they are finding short of money. So that is made arranged. But Karnataka State Apex Bank, from where they will pay? Of course, it has got the deposit they have collected, profits, whatever. It has got the fund, but they are entitled to have refinance facility from NABARD. NABARD is a creature of RBI. You understand? So NABARD, what is the full form of NABARD? National Bank for Agriculture and Rural Development. It is meant for development of rural economy. Rural economy cannot be developed. Go in rural area, start establishing industry, small scale sector at the cost of agriculture. It cannot be called rural. If it is rural, the word rural is associated always with agriculture. You don't call them as employees, you call them as farmers. Okay, they need, if we are to be fed, then we need farmers to be encouraged. Not only encouraged during the time of cultivation, but also during the time of marketing their produce. Where we are failing, there we are failing. Today we are failing even at the initial stage by allowing malpractices even while selling seeds. Very poor quality seeds and all. RBI, you should conduct sufficient inspections through banks or through some mechanism. The promotional function. See, you are not there only to ensure that central banking or supervisory function. You should also, if promotional function is some sort of a social responsibility, CSR, corporate social responsibility function. RBI, yes. I said IBRD, IDBI, Industrial Development Bank of India, ICICI, Industrial Credit Investment Corporation of India, National Bank for Rural Development, Agriculture and Rural Development. These are all the brainchild of RBI. Therefore, RBI has done it, what for? To promote industry by providing industrial finance through this. Why should I be always dependent on externals like SBI, this and all? I will have my own National Bank for Rural Development. It is entitled to have even World Bank's loan credit, World Bank credit facilities also. So I will have my own banks like industrial credit is concerned, industrial finance is concerned, ICICI, IDBI, like agricultural credit is concerned. This finance will be rendered by National Bank for Rural Development. So that is a promotional function. RBI, therefore, you are performing your functions, and your functions are threefold, namely central banking function or main banking function. And in the central banking function, we have seen issuing of notes, banker to the government. In the bankers to the government, apart from banking operation to the government of state and center, it is also a financial agent and a financial advisor to them. Bankers bank, we have seen how I am a customer to the bank. What all facilities available to me? Those are the facilities available to the banks from RBI. Therefore, RBI is a banker to the banks. RBI is not a banker to the individual. Then, controller of credit. Extremely important, controller of credit. RBI is a controller of credit. RBI exercises its control over credit through two ways, quantitative and qualitative credit control. We have seen quantitative credit control is exercised by RBI prescribing bank rate policy, variable cash reserve, open market operations, variable statutory liquidity ratio, variable net liquidity ratio. Okay. And selective credit control or qualitative credit control is exercised by RBI over the banking operations of the banking system in India. It may be cooperative bank, it may be commercial bank, or it may be non-scheduled bank, whatever. How qualitative or selective credit control is exercised? By directions, issue directions. You have got the power. You are a parent of all banking structure in India, system in India. Issue the directions. Then marginal requirement, regulation of marginal requirement. Then diversification of risk. What it is called? I have told you. Diversification of risk is called diversification of risk is called, in fact, sector's priority. Then moral suasion. I will get you that point. Moral suasion. Then marginal requirements. I mean, through these, what do you mean moral suasion? As I said, no question of punitive action, but trying to persuade him through moral principles, ethically trying to persuade him. You understand? I have given you the best example that a son is indulging in the habit of consumption of alcohol. Son is indulging in the habit of consumption of alcohol. Okay, son is in the habit of consumption of alcohol. In which case, how the fathers or the relatives or the friends will go? Whether they will administer punishment on him? No. They will be trying to morally appraise on him. See, these are the consequences. See, it will affect your life. It will take away your life. Your life is very important to us. So that way, you are trying to ethically, going deep to him so as to appraise him the need to stop consuming. Likewise, the RBI will go to all the banks, trying to morally, trying to inflict upon them, trying to appraise upon them by moral suasion. SUA. When I say suasion, it is persuasion. It is trying to persuade the banks, don't indulge in those kind of practices as it would lead. As I said, what kind of practices? Beyond, say, it may prescribe up to 10 crores, you don't need. Bank, you can grant loans. But when it is more than 10, I don't mean to say 10 only, whatever. But if you are granting a loan of 10 crore and above, then don't grant it without the prior authorization of RBI. RBI may do it. Why? It is not that I am trying to dictate upon you. It is trying to save you. Whether you can grant a bigger loan, if you grant a bigger amount by way of loan, if it is not insured, if it is not repaid, what will happen? You will collapse. If you collapse, people of the country will collapse. Therefore, to prevent all that, then restriction on clean advance. Don't grant clean advance. As I said, what point which went out of my notice? I said first point is directives. Second point is regulation of marginal requirement. Third point is differential rate of interest. Rates of interest as far as the advance of the loan that you grant differs from subject or object, whether it is agriculture, whether it is finance, whether it is self-employment, whether it is vehicle, whether it is housing, whether it is education. Similar like that. Also bother about the sound, comply with the sound principles of banking, but you should always have differential rate of interest. Interest rate should not be the same. Agriculture, you should promote lesser rate of interest. Industry, maybe higher than agriculture. But when it comes to vehicle, when it comes to luxuries, then I am not coming in your way. You want to fix it 16, right? Their competition, rules. Because many banks are there in India. One fixes 14, another fixes 10. It is up to him, and I am not coming in the way. Differential rate of interest should be there, and restriction on clean advance, prior credit authorization scheme, then credit monitoring arrangement, loan granted. Please, don't be always be dormant or sleeping that it will be repaid. Not only granting of the loan, your job is not over. You should also monitor whether the loan is properly administered. Why? Your monitoring is not always to encroach upon. Your monitoring is to ensure that it is properly applied. Your growth, the borrower's growth also should happen. When the teacher monitors the performance of a student will always be having some sort of fear. That will make him study. Who will be grown? A teacher also will be happy because he finds student is happy. He finds student is academically good. That's what I mean to say. You should monitor. Then lastly, moral suasion and sealing on bank advances. Okay. This is what there. And finally, I said, you are a controller of foreign exchange operation also. Why? Because you should sustain Indian currency value. You should always promote the earning of foreign currencies rather than purchasing of foreign currency. If the purchasing of foreign currency happens, there will be a serious burden on, because if the government of India is to purchase so many barrels of crude oil, if it doesn't have foreign exchange reserve, then it may have to purchase the dollars. How to purchase dollars? For $1 you need to pay 74 rupees. But if you have the dollar, if you have earned the dollar already, then therefore I said you should purchase, promote the earning and discourage purchase of foreign dollars. If foreign dollars are always purchased, then Indian currency, I think right now it is 74, it may go up to even 120 rupees. In Zimbabwe it happened. They demonetized their currency at all. Why? No value at all. That situation India should not face. Therefore, our credit, economic, monetary policies are always good enough to sustain Indian currency, to sustain economic development of the country. For that, RBI is being the chief economic advisor to the country, to the bank, to the government. Understand? And by being the chief economic advisor to the banks and to the governments, it is able to exercise its clout in respect of the economic growth of the country as a whole. Everyone is looking in times of budget or in times of every quarter, every people of India, not only the agriculturists or auditors, but every people of India eagerly eyeing at the RBI's, what is that in this fiscal or in this quarter, what is the bank rate policy of RBI, etc. So that is very much interested. Of course, the depositors will be, if the bank rate policy goes down, depositors will be frustrated. If the bank rate policy goes upwards, depositors will be, yes. But what about the borrowers? See, bank rate goes up, depositors will be happy, borrowers will be unhappy. Bank rate goes down, depositors will be unhappy, borrowers will be happy. Likewise, as I told you, if liquidity is huge with the bank, then to contain them, from playing with the liquidity, because bank's money is not bankers' money, it is public money. So a bank should not play with that huge form of liquidity. That time what RBI will do? It will either sell its securities to the banks or it will purchase bank securities. When it sells securities, banks will have to pay to RBI. No other go. Then bank security is contractioned, narrowed. When it purchases bank securities, RBI will pay them. Then bank's liquidity is widened or expanded. This way we have seen central banking function, supervisory function and promotional function. Okay? We have seen all those in detail. This is extremely important. I can tell you 100% guaranteed. You will find in both section, it's a unit 2, 2A or 2B. You understand? 2A or 2A. 2B or 2B. Even in 2B, you will find a question from RBI. Like NABARD, like controller of credit, like what is that called, clearing house, like management of RBI. Any short note may be coming, but SHIVA, explain the management department, and or rather main question will always be RBI, Reserve Bank of India, is the controller of credit. Explain. That's why I have stressed so much of importance on that. Otherwise, explain the role of RBI in the economic development of country. You have tried the functions. Explain the functions of the Reserve Bank of India, or the functions of RBI are threefold. Threefold are this. Okay. There is scope for 2B also. Another 2A question will be Deposit Insurance Corporation of India, which is very briefly I will make a mention now itself. Yeah, I will make a mention about that Deposit Insurance Corporation of India right now only. What is the Deposit Insurance Corporation of India? Yes, you need, as I said while in the course of our discussion, banks' deposits. What are the chief sources of bank fund? Let us come to that. We are now discussing this. Very important. What are the chief sources of bank fund? The chief sources of bank fund, at least I will tell you, the bank fund is divided into two, namely owned fund and borrowed fund. What is that owned fund? Owned fund, your reserves, profits, undistributed profits, I think, and your the capital, initial capital, they form your own fund, owned fund. But what is that borrowed fund? When I go to the bank, open a SB account or FD account or RD account or current account, it will make the banker inevitably, because of the system, it will make the banker inevitably a debtor. Remember, I am creditor. Customer is a creditor. But customer's position may be changed. When the customer, to one account customer is a creditor, to another account when the customer borrows from the bank, he may have the account there. When the customer borrows from the bank, then customer becomes a debtor, banker becomes a creditor. But I am telling you with reference to one account only, it will reverse the position. For example, current account hold. I am the current account holder. I have deposited and opened a current account. Banker is the debtor, I am the creditor. But from the current account, when I have overdrawn, when the overdraft arrangement is there, we have seen what is that overdraft and all in the commercial banking function. When I overdraw, that is over and above that deposit, if the overdraft arrangement facility is taken, then up to that moment I was a creditor, customer. But when I overdrawn, since the facility is there available only to current account, overdraft facility, when I overdraw from the current account, who am I? I become debtor. It reverses. John Paget clearly said, the relationship between banker and customer is primarily that of debtor and creditor. the respective relationship is regulated, the respective relationship is defined by the existing state of account. If the state of account always shows plus balance to the customer, customer is a creditor. But when the customer borrows, he becomes a debtor. That is why the relationship between banker and customer is primarily that of the debtor and creditor. The respective relationship is determined by the existing state of account. We cannot say, for sure we cannot say that banker is a debtor, is a creditor. It depends. Whether your account shows plus balance, 100% you are creditor. But when the account shows minus balance, in other words, when you borrow from the banker, you become, your position will change. We will discuss in respect of general and relationship between banker and customer. It's very, very important. Subject 2 questions will come, and it itself is spread over to unit 3. Right? You have got borrowed fund. Owned fund is your own. And that owned fund will always be expanded when you earn more and more on your own by carrying of your activities. Borrowed fund, how it is constituted? Borrowed fund, 1, acceptance of deposit from the public. You are borrowing. You can't say that I am not a borrower. I know it is not a debt. Whatever you have borrowed is not debt. It is called deposit by a dignified term. But by accepting deposit from the public, you become it is called borrowed fund, 1. By having, by borrowing from Reserve Bank of India, you can, just finished, we have discussed. Reserve Bank of India is a banker to banks, correct? So you can, in times of need, you can borrow from the RBI. So therefore, any borrowing from the RBI, or any borrowings from other banking institutions. I am SBI. In times of need, I can take borrowing from other banks. So this is called borrowed fund. So there are 2 funds which will form the bank monetary corpus, owned fund and borrowed fund. Now the question is that, let us not bother about this owned fund. Okay, let us not bother about this owned fund. Bank's borrowed fund. Don't you think when the bank borrows fund, should it not be returned? When you borrow, undu hoda kondu hoda. It means you have borrowed the fund, no question of making repayment. Then who will lend you tomorrow? 1. Then who will have confidence or credibility or faith in the banking institution? Don't ever do. And RBI has got the role to ensure that all banking institutions in the country, which is responsible for its birth, RBI, it should monitor the banking operations. If it is not properly monitored or regulated or inspected, then RBI will be finally responsible for all nonsense. Economic development becomes only a dream, and it will ensure that, my hard-earned money I have deposited to the bank. Unfortunately, bank collapsed. Bank liquidated. My money gone. Then the Karorpati becomes Bhikshadipati. You should not be doing that. Therefore, whatever borrowed fund, Mr. Bank, you have borrowed fund. Your fund is also the component of your capital structure. Owned fund and borrowed fund. Borrowed fund borrowed from the public by way of deposit, borrowed from the RBI, borrowed from other financial institutions. You have borrowed. But those borrowings should be guaranteed, Those borrowings should be guaranteed. It means, I mean to say, let us not go to RBI. Let us not go to borrowing from other institutions. Let us go to customers. When they deposit their money by opening one or other form of account with the bank, they have deposited. How much they have deposited? As I said, hard-earned money you have deposited there. Should it go? Should it go perish? No. It should earn interest rather than perishing. With that hope only I have deposited my money. Okay. What is the guarantee that it will be repaid? We are all under the very, soft, what is that? Soft confidence. We are all under the easy and the soft confidence that it will be repaid. But sorry, if the bank suffers, if the bank goes into liquidation, what happens? If the bank goes into liquidation, then the banker is unable to repay the amount. It happens. It had happened in UTI. It had happened in Yes Bank very recently. When some sort of mismanagement and RBI is about to It happened in our Bangalore city only to some cooperative banks. Due to mismanagement, the RBI passed an order freezing the account or operation of the account itself. In such a case, customers will be affected. Whether their deposits are guaranteed? No, their deposits are not guaranteed. But remember, there is one confidence that will be given. Of course, you have got many other provisions under the banking law, like CRR is one confidence. Understand? SLR is another confidence. Remember, say for example, the entire earnings of the bank is about 100 crores. Whether 100 crore amount itself could be lent by way of loan and advance, or could it be invested? No. Some percentage of that out of 100 crore of theirs, which they have collected by way of accepting demand or time deposits, 3.5 as it now stands percent will have to be with the RBI. And some 18.5% right now, I think it should be with the bank itself. Please note, you have taken those savings deposit, fixed deposit, recurring deposit from the customers for whom you have promised to repay with interest, correct? Right. Out of the so much of money that you have borrowed from the people in the form of deposits, you have promised that, there are regulations like cash reserve ratio out of 100 crores at 3.5% should be deposited with the RBI, which attracts no rate of interest from RBI to banks. Statutory liquidity ratio, that is, when the bank is able to garner 100 crores, out of that 18.5 crores should be with them only to meet the regular day-to-day repayment or withdrawal needs of the customers. It comes to about 22% right now. So at least this is the guarantee that you have. Who has it? Every customer can have this much of guarantee that even if when the bank goes into liquidation, at least as per the statute requirement, every bank is bound by this. 22 crores will be there with the bank. 22 crores to that extent, yes. One more. Now I am giving more confidence to the customer of the bank. What is that more confidence? Every deposit, every deposit holder, their interest will be taken care of, and as a result, their deposits are guaranteed under Deposit Insurance and Credit Guarantee. It was Deposit Insurance Corporation of India, under the Deposit Insurance Corporation of India Act 1962 to begin with. But in 1972, this is also been guaranteed. Therefore, it is amended and now it is named like Deposit Insurance and Credit Guarantee Corporation of India. It is a corporation, Deposit Insurance and Credit Guarantee Corporation of India, under the Act of Deposit Insurance Credit Corporation of Act 1962, wherein the bank deposits must be insured. Say for example, I go to SBI and deposit, I have deposits worth rupees 10 lakhs. 10 lakhs. I have deposits worth rupees 10 lakhs. My 10 lakhs are guaranteed. Oh, now the question comes. Up to February 2020, up to February, some initial date, 2020, as per this enactment, the customers' deposits are guaranteed in the RRB, in the cooperative bank, in the scheduled bank, and in the nationalized commercial banks. Their deposits in all these banks are guaranteed to the extent of 1 lakh. To the extent of 1 lakh. But now it is increased to, since from February, the present finance minister in the present budget, it was increased, already order passed, to 5 lakhs. That's a good news. How much you have in your account? 50,000. If the bank liquidates, no worry. You will get back your 50,000. And don't think you will get 1 lakh. No. Up to it is said. If you had 1.5 lakhs, you will get only 1 lakh. You understand? If you had 1.5 lakh at the time of liquidation of the bank, as per the deposit insurance scheme, you will get only 1 lakh. If you had less than 50,000, then you will get whatever you had in the account. That is guaranteed if it is within that insurance sum. But now that is increased, enhanced to 5 lakhs. Because at this present rate, even 1 lakh is no money at all. That is why that 1 lakh insurance was insufficient, considering that it was lying long since from its inception till date 1 lakh. But now it is increased to, fortunately, at least 5 lakhs. That means customers of larger deposits, at least they will have a satisfaction that their 5 lakhs, not I said up to 5 lakhs. Whatever in the account you had, that much is guaranteed up to the extent of 5 lakhs. But not that when you had only 1 lakh, you will still get, when the bank goes to liquidation, you will still get 5 lakhs. No, it is not like that. You will get only whatever amount you had. And if your amount is up to the extent of 5 lakhs, you will get that much guaranteed. But if it is, I had how much? 10 lakhs. When the SBI goes into liquidation, anyhow, my 5 lakhs is guaranteed. Okay, my 5 lakhs is guaranteed. I will not get 10 lakhs, that is what. But there is one problem. If I have accounts in several banks, when I have accounts in several banks, whether I will be guaranteed 5 lakhs in each of the banks is a big question, remain unanswered. Okay, right. But how it is administered? How it is, administered? How it is administered? It is administered, by Deposit Insurance Corporation. It is administered because you have to provide safety to the, especially to the small depositors. To provide safety to the small depositors, to protect the depositors, especially small depositors, against the risk of losing their savings in the event of banks' inability to, meet their liability, the scheme is of extreme use. You understand? The main objective of Deposit Insurance, Act is to give protection to the depositors, especially the small depositors, against the risk of losing their hard-earned savings in the event of bank's inability to meet its liability, and thereby assist the banks in, this act, by passing this act, it is a protection to depositors, especially small depositors. Their hard-earned money is saved, thereby bank, you have helped capital formation, you have helped investors, small depositors to earn interest also. Therefore they have done. So you have to, secure their interest, you have to secure their faith, correct? And when this kind of enactment is also passed, then even the depositors, even the customers who are willing to deposit, they will not have a second opinion. They will not be apprehended because, Deposit Insurance Great Guarantee Corporation of India Act guarantees, so I will go and deposit. Thereby it will help capital formation. Thereby it will help to mobilize deposits. And fund movement, fund is very important. Liquidity is very important for any growth as such. You should always reduce the risk. Otherwise what happens? When you find that one bank is approaching its liquidity, or any apprehension comes, then everybody will run up to the bank branches and stand in the queue to draw their money. Bank will go to liquidation. So to prevent that, this enactment is very much, to prevent such kind of situations, this enactment is of great use. And there are two funds. One is general fund, one is deposit insurance fund. If general fund is constituted, general fund is constituted with a built-up capital and reserves, as well as income accruing from the investment of those funds after meeting the work expenses of the corporation. What are those two funds? One is Deposit Insurance Fund, DIF. Another one is General Fund. What is Deposit Insurance Fund? I will tell you. Deposit Insurance Fund is constituted by premium payment, 15 paisa for every 100 rupees of deposits. 15 paisa for every 100 rupees of a deposit. So how much of deposit I have? It's 10 lakh. So they will not cut from my interest. Whatever interest I have deposited a sum of 10 lakh with the SBI for 1 year at the rate of 6%. So I will get 60,000 rupees interest for that 1 year. So I will get 10 lakh 60,000 rupees. Okay, it is like minus tax, 10% tax, TDS will be done. Okay, anyhow, But they will not cut that. Who will pay the premium? And my deposit is insured. Though I have got 10 lakhs deposit with the SBI, my deposit is insured to the extent of 5 lakhs. Correct? And who will pay? See, if you are to provided with the, if you are to be provided with the insurance, security or insurance scheme, then you are to pay, premium. Who will pay? Banker will have to pay from out of his earnings out of these deposits. You understand? So 15 paisa for every 100 rupees. It will not be, the burden will not be passed to the customers of the bank as such. So for 15 paisa for every 100 rupees, banker will pay as a premium. So my entire 10 lakh deposit is 10 lakh deposit is secured, guaranteed. But you know that what is that insurance? It is only up to 5 lakhs in the event the bank goes to liquidation. Correct? And 15 paisa for every 100 rupees. 1000 rupees it becomes 1 rupee 50 paisa. Correct? For 100 rupees 15 paisa means for 1000 rupees 1 rupee 50 paisa. And for 10,000 rupees it is 15 rupees. Okay? For 1 lakh rupees it is 150. Remember, for 1 lakh rupees 150. For 10 lakh rupees it is 1,500. Who paid it? That burden will not be passed to the customer. Customer, for your 10 lakh, you will get the agreed rate of interest. What is that? 6% minus taxes. That is TDS, 10%, right? You will get. And Mr. Banker, to provide you 6% interest for 10 lakh, he will have to, employ that fund. Because otherwise, how to pay him 6% interest? I have to employ fund. What way? I have to lend. I have to, invest. See, lending, advances, investment, somehow I have to do. Banker will do. Otherwise, he cannot pay you the interest. He cannot, take care of his infrastructural expenditure, administrative expenditures. Plus, remember, out of his earnings, out of 10 lakh, for 1 year, he may earn about 1.5 lakh rupees. I am telling you, 1.5 to 2 lakh rupees, he may earn about 1.5 lakh guaranteed. Out of that 1.5 lakh, he pays 60,000 to customer. Okay? Then salaries. Then expenditure, so much of expenditure. Plus remember, 1,500 is paid to Deposit Insurance Credit Guarantee Corporation. You understand? It is a corporation, a distinct legal entity under the Act of 1962. He pays 1,500 rupees. And when he paid that 1,500 rupees, if SBI gets liquidated during the said year, it means I am the customer, I deposit 10 lakhs. Does it mean to say that my 10 lakhs 60,000 is gone? No worry. See, I don't know whether I will survive. It is there. But at least I will survive with confidence. What is that confidence? See, I have deposited there. I don't think in terms of, what is that, negativity. But in the event if the bank suffers, liquidates, at least 5 lakhs is guaranteed. Up to 5 lakhs, up to the extent of 5 lakhs. If I had only 4 lakhs, I will get 4 lakhs, not 5 lakhs. If I had 10 lakhs, I will get only 5 lakhs. That much is insured. It was 1 lakh up to February 2020, but since from February 2020, the government of India revised it to 5 lakhs. Good. Okay, to that extent at least. So for that, a premium is paid by them. This premium will not be returned. In the event that year nothing happened, it is like motor vehicle insurance. If no accident happened, money will not be returned. So similar like, this premium will be paid at the rate of 15 paisa for every 100 by the said banker in respect of the deposits. So it will know what is the total deposit, demand and time deposits. As you know, current account, savings account, RD account, and what is that FD account. Total deposits, how much? On the basis of that, 15% you have to pay. And almost all the banks, whether it is commercial bank, scheduled, non-scheduled, cooperative bank, industrial finance bank, or regional rural bank, all banks are now covered by deposit insurance. By having this coverage, what are the advantages? I'll tell you the advantages of the deposit insurance scheme or credit guarantee scheme. Credit also, when the banker extends credit to customers, that is also guaranteed. When through this scheme, there are two major benefits. One, safety to depositors. Two, by that safety to depositors, they will never apprehend, they will never have second opinion. They will go straight away to the bank. Hey, even if the bank suffers, I will still get back my money up to the extent of 5 lakhs. So don't you think this scheme, this act has helped to wash off all the apprehensions of any liquidation, all apprehensions of any closure of any bank on account of losses? Because even if that happens, it will be there. This much is there. So it will help to mobilize the deposit and thereby helps the capital formation. Because for anything, what we need is money. Correct? So it will help. It will give security to the bank. It will give security to the customers. It will help mobilization of deposits, and it will wash off all the apprehensions of liquidation proceedings and all. But the banker only pays from out of his earnings all those what is that called, premiums. And it is managed by, see, Deposit Insurance Corporation is managed by what is that called, a board of directors consisting of governor for the time being of the RBI, who is the chairman, and deputy governor of RBI nominated by the RBI. Okay, governor of the RBI is the chairman of this Deposit Insurance Corporation. Deputy governor of RBI nominated by the bank. 3. An officer of the central government nominated by that central government. 2 directors, totally it has got 2 directors nominated by the central government in consultation with the Reserve Bank. 2 directors nominated by central government in consultation with the RBI. Those 2 directors must be persons of some eminence, having knowledge with reference to insurance, maybe insurance regulatory mechanism, whatever, insurance, law of insurance, or trade, or various sectors. They must be persons of eminence in those fields, having specialized knowledge. And from such categories, 2 directors could be nominated by the central government. So totally it has got 5. Central board of directors, a board of directors. Deposit Insurance and Credit Guarantee Corporation of India Act 1962 is managed by a board of directors comprising of 5 directors, of whom 1 will be the chairman, normally the RBI governor. If RBI governor is not there, then the deputy governor will be the chairman. 1 RBI governor, then deputy governor of RBI, then officer of the central government, and 2 other directors appointed by the central government, picked from such persons of eminence list. Okay, right. And this manages, what for? It will introduce from time to time the insurance reforms, and also there are compulsion with that. When the Deposit Insurance Credit Guarantee Corporation is established, then it should ensure that all the banks in the country must be members to this, must be registered. All the banks must be registered with the Deposit Insurance Credit Corporation of India Act. No company, it is under the Companies Act. No company can carry on its business without getting registration, correct? Or licensing from the appropriate government, right? Similarly, no banks can exist without those banks registering with. When it is registered, what are the advantages? Just now I told. So therefore, it requires Deposit Insurance and Credit Corporation of India Act, Credit Guarantee Corporation of India Act will also contain provisions requiring all the banking system should be registered with this. When it is registered with that, it is not that a source of earning for Deposit Insurance Corporation, but it is a source for inflating the confidence in the minds of public with the banks. Thereby it will help banks to increase the supply of funds, mobilization of deposits. You kindly go through the composition, powers, functions, or composition, management and advantages of Deposit Insurance Credit Guarantee Corporation of India Act 1962.